Welcome to The Explainer. Today, we're taking a seriously fascinating journey, moving all the way from that stressful, messy shoebox full of crumpled receipts to achieving true, undeniable financial mastery in real estate. Because, listen, whether you own a single rental or manage a massive, sprawling commercial portfolio, the way you handle your numbers absolutely dictates your success.
Okay, let's dive into this. It's a tough question, but it's one we absolutely have to ask. Are you treating your properties like a legit business or just a very expensive hobby? I mean, when you're relying on chaotic spreadsheets or you're waiting until tax season to figure out if you actually made any money, you're operating a hobby. Businesses, on the other hand, they demand clear systems, predictable data, and proactive financial management.
Section 1. Treat real estate as a business. This is all about establishing that rock-solid professional foundation.
So if there's a cardinal sin in this industry, it is commingling personal and business finances. You absolutely must store your property income in a dedicated business account. It seems super simple, right? But you'd be amazed how many investors accidentally pay for their family's Netflix subscription or even a personal vacation out of the exact same account they use to collect rent.
Why is this so incredibly dangerous? Well, because mixing funds literally murders your profits, and honestly, your sanity too. It leads directly to lost tax deductions, massive audit nightmares with the IRS, and completely skewed performance data. Think about it. When your personal coffee run gets mixed up with a property's utility bill, it becomes physically impossible to accurately track that asset's health. You just lose the clarity you need to grow.
Section 2. Bookkeeping versus real estate accounting. Let's look at the core difference between merely recording history and actually predicting the future.
And this brilliantly illustrates the contrast here. Think of bookkeeping as laying the daily bricks. It's the essential groundwork, right? Recording rent payments, logging utility bills, keeping the ledger organized. But real estate accounting, that's acting as the strategic architect. Accounting takes all that daily transaction data and interprets it for profitability, asset valuation, and high-level tax strategy.
As this quote perfectly sums up, accounting just goes deeper. It isn't just about knowing what you spent, it's about knowing exactly why it matters. Proper real estate accounting is what empowers you to make critical strategic decisions, like exactly when to renovate a unit, when you finally have the equity to refinance, or when it's just time to sell.
Section 3. Choosing your accounting method. This is where we choose the framework that actually builds your financial story.
Let's move to and see how this builds. There are really two primary methods to build your story: cash basis versus accrual basis. Now, cash basis is super simple. You record income when the rent check hits your bank account, and you record expenses when you pay a vendor. It's highly intuitive, and it gives you a quick snapshot of your immediate bank liquidity. But accrual accounting is different. You record income when it's earned and expenses when they're incurred, completely regardless of when the cash actually moves.
Let's zoom in on accrual accounting for a second. This method perfectly matches the rent you earned with the exact cost that supported it during that specific period. And while cash basis might feel a lot easier for a beginner, lenders overwhelmingly prefer accrual accounting. Why? Well, because it smooths out those weird short-term cash crunches, like, say, a tenant paying rent 3 days late, and it shows the property's true long-term operational stability.
So, the whole reason this is so crucial is that choosing the right accounting method allows you to accurately calculate your net operating income, or NOI. Let's demystify this industry jargon real quick. NOI is simply your gross rental income minus all your property-related operating expenses, so things like maintenance, property taxes, and insurance. Note that it does not include your mortgage payment. NOI is basically the ultimate metric for calculating an asset's true operational efficiency, and it's directly used to determine the property's overall market valuation.
Section 4. Essential real estate financial reports. To track a metric like NOI, you need total, uncompromised visibility. This is your command center. Okay, here are your big three. First up, the rent roll. This is your operational backbone and your early warning system for vacancies. It's also, by the way, the very first document lenders are going to ask for. Next is the P&L, or profit and loss statement. Think of this as your historical profitability scorecard, showing your revenues and operating expenses over a specific time frame. And finally, the balance sheet. This gives you a snapshot at an exact moment in time of your assets, your liabilities like mortgages, and your ultimate equity in the property.
Now, what's really interesting about this slide is how a well-built cash flow statement separates your money into three totally distinct streams: operating, investing, and financing. Operating is your day-to-day rent and vendor payments. Investing covers the big capital expenditures, like slapping a new roof on the building. And financing covers your mortgage principal and owner distributions. This structure is just brilliant because it totally stops landlords from looking at a fat bank account and confusing a one-time mortgage cash out with actual day-to-day operational success.
Section 5. Turning data into strategic growth. Let's look at how interpreting all this data actually fuels your portfolio expansion.
Look, as your portfolio scales, spreadsheets literally become a liability. You're eventually going to hit specific triggers that force you to graduate to specialized property management accounting software. Those triggers usually include a rapid growth in your property count, increasingly complex tax and regulatory requirements, a serious desire to professionalize your operations, and of course, the strict reporting demands of lenders when you're trying to secure new financing. Because, the ultimate goal here isn't just to ditch a spreadsheet for the fun of it. It's to reclaim your time, vaporize those costly errors, and get the real financial clarity you need to make smarter, faster moves. Adopting true real estate accounting unlocks your ability to maximize your revenue, minimize your debt, and confidently scale your operations without feeling like everything is just going to crash down around you.
I want to leave you with this one final provocative thought. Your properties might be generating revenue month to month, but is your accounting system actually helping you generate wealth? Are your systems giving you the actionable insights to grow, or are they secretly holding your real estate empire back? Take a really hard look at your books and decide if it's finally time to upgrade from a simple bookkeeper's history lesson to an accountant's strategic roadmap. Thanks so much for joining me on this explainer.